On Friday, March 10, 2023, after a run on the bank, Silicon Valley Bank was closed by regulators as the FDIC took over the bank's deposits and put the bank into receivership. The shutdown of Silicon Valley Bank marks the second largest bank collapse in U.S. history as the U.S. startup ecosystem loses its largest bank partner, with the remaining cash deposits with the bank under great uncertainty. With 50% of U.S. venture-backed tech and life sciences companies banked by SVB, many startups and investors alike have cash frozen and now are scrambling to find cash to continue operations as the already battered startup ecosystem struggles with the weak fundraising environment due to rising interest rates. Today we'll explain how the bank run on SVB occurred and the potential effects of its collapse. Silicon Valley Bank, the 16th largest bank in the U.S. with $173 billion in deposits before its collapse, operated primarily as a commercial bank that collected the deposits from businesses financed through venture capital and lended to the same startup ecosystem at a higher rate for venture capital-backed companies and institutional investors to manage cash flows to continue operations. For venture-backed startups, Silicon Valley Bank was the market leader for venture lending to provide startups with additional cash runway, with credit underwritten on the startup's ability to either raise another round of venture capital or reach profitability. On top of principal, interest, and fees on debt, Silicon Valley Bank also earned warrant income that gave the bank the right to purchase shares from their lending relationships that could be lucrative in a startup exit, an M&A, or IPO. For investors, when venture funds raise money from institutional investors, they don't necessarily receive that money immediately. Often, the venture funds will finance their activities by drawing against a line of credit provided by Silicon Valley Bank to then repay the bank later, after they've made a capital call to their limited partners. During the pandemic era of 2020 and 2021, venture funds experienced a surge in deposits driven by low interest rates, with U.S. venture capital-backed companies raising $330 billion in 2021, almost doubling the previous record a year before. In March 2021, the bank was awash with cash as total deposits exploded higher over the prior 12 months, so about $124 billion from $62 billion previously. Banks need to deploy customer deposits, and Silicon Valley Bank took in tens of billions of dollars from its venture capital clients and then invested that cash into fixed-rate bonds such as U.S. Treasuries and mortgage-backed securities with terms of 10 years or over. These carry minimal credit risk but can have sizable interest rate and duration risk with fixed rates at longer terms. At the end of 2022, SVB held $117 billion of securities, which accounted for the bulk of its $211 billion in assets. A key finance fundamental: bond prices move inversely to yields or interest rates. When you have a fixed stream of cash flows from bond coupons, but the market interest rate increases relatively over the lower previous rate, the present value of the bond decreases. In SVB's case, the interest rates on its bond investments were both fixed and were at record lows from the pandemic era. As interest rates rose sharply and the bond market cratered in 2022, SVB's bond portfolio took a huge hit. On Wednesday, March 8, 2023, SVB reported the sale of $21 billion of its available-for-sale securities, which resulted in an after-tax loss of $1.8 billion. The accounting treatment of the bonds to not recognize the unrealized losses in advance, although acceptable to regulators at the time, exposed that the sale of its remaining held-to-maturity securities in the current interest rate environment would also be at a loss, with the bank's assets potentially depleting to a level of insolvency. Silicon Valley Bank had planned to raise capital to maintain liquidity with a $2.25 billion offering. But the timing of the press release, with capital still pending and not yet secured, was arguably terrible, as the bank unraveled and its stock price dropped 60% before trading of the stock was halted. Silicon Valley Bank Chief Executive Greg Becker held a conference call Thursday advising clients of Silicon Valley Bank to stay calm. Before Thursday, venture capital investors like Peter Thiel and his firm Founders Fund had begun advising their startups to pull cash out of their Silicon Valley Bank accounts, beginning the unraveling of the bank. Group chats and messages got out that investors were pulling money out of the bank, starting a feedback loop, fueling a self-fulfilling prophecy of the insolvency of SVB. By Thursday, SVB had experienced over $40 billion in deposit withdrawal requests, truly making the bank insolvent. By Friday, the FDIC took over and shut down Silicon Valley Bank, creating the Deposit Insurance National Bank of Santa Clara as a receiver of Silicon Valley Bank deposits. On Sunday, March 12, 2023, Treasury Secretary Janet Yellen announced that the federal government would not bail out Silicon Valley Bank, but work to help out depositors. FDIC insurance guarantees $250,000 in cash for each depositor, but more than 85% of deposits remain uninsured. An auction process is underway to find a buyer for Silicon Valley Bank, but without a clear plan to provide relief for the clients of Silicon Valley Bank, startups and investors alike will have difficulty continuing operations with their cash frozen. In the short term, this could mark the death knell for startups already struggling with low runway, now unable to access the little remaining cash it had, and little prospects of bridge capital from investors. In the long term, big bulge bracket banks will gain more deposits and an increase in market share as trust erodes in smaller regional banks. For venture lending, there will be a large gap that, if not filled by bulge bracket banks, will be advantageous for private direct lenders. Should no plan come in the form of either a buyer or government support for depositors in the next couple of days, panic could later spread to regional banks as innovation is stifled in the US and contagion also potentially spreads outside of the tech sector. A key piece of infrastructure of the startup ecosystem is in jeopardy, and it remains to be seen who will pick up the pieces.